Welcome back. The next corporate conversation that we have going is from L&T Infotech, LTIMindtree. Now, this is the first time the company is reporting numbers post their mergers. And Q3 numbers were a miss. It was a miss on revenues, a miss on margins. Margins, in fact, have contracted very sharply, about 350 to 500 basis points if you look at it quarter on quarter or on a year-on-year basis. That said, the company has given a 4 to 5 year vision where they are talking that this merger will result in $1 billion of revenue synergies and will also help improve the company's margins by 200 basis points. That perhaps has taken some of the stink out of the Q3 numbers because the stock has recovered from the lows. I had a chat with Debashis Chatterjee, the MD and CEO of LTIMindtree. I began by asking him about the Q3 top-line miss. What was the impact of furloughs, the lesser working days on the company's performance? Listen in.
We had an impact of 130 basis points because of furloughs and lesser number of working days. And we anticipate that bulk of that will be nullified as we move into Q4. And apart from there was also 100 basis points impact due to the integration cost that we had to take. And bulk of the integration cost we have already taken in Q3. There'll be a little spillover in Q4 as well. And having said all these things, we are very confident that as we get into the Q4, for our Q4, we will have 200 to 250 basis points improvement in terms of our EBIT margin. And as we get into FY24, we should be able to, for the full FY24, we'll be again operating at our erstwhile margins that we used to talk about in terms of our profitable growth story.
So FY24 margin should be 17.5%?
It is, we don't give a guidance, but, if you do the maths, you can figure out. But yes, definitely we will get back to what it used to be as a merged entity before Q3.
Okay. The impact that you indicated on account of furloughs integration was on the margins. Could you tell us the impact on the top line?
No, as far as the top line is concerned, we did have, if you have furloughs, then you do have an impact on the top line as well. But overall, our accounts grew fairly well. We had a good sequential growth. And, if you look at the YOY growth, it is around 14% and 16.3% in constant currency, which is very encouraging and which is still in the top quartile for all the within all the IT players. So we are very confident that we'll continue with that growth as we go along.
So what could Q4 revenue growth look like for you?
Well, I think the momentum that we have in terms of our pipeline and the deals that we have closed in Q3, if those things continue, I think the Q4 growth will be definitely in line or better than what we had in Q3.
Okay, so Q4 growth better than Q3, which was 1.9% in CC. You spoke about deferrals in some projects. Which segment, how many projects got deferred?
Well, I think, it's difficult to call out how many projects and all those things, but let me tell you that some of this deferral is not something which is just, either a sector specific or, a set of client specific. Across the board, we have seen there are some projects which got deferred and some projects where the decision making has been slow. But the good news is that across the entire portfolio of our clients, we have not seen any cancellation. In fact, what we are seeing right now is there are a lot of opportunities which is all about cost takeout. How do you bring more efficiency in the system? And the reason why clients are jumping on those initiatives is they want to continue to fund their in-flight transformation programs. And by taking some cost out of the system, they should be able to fund those transformations which we are already participating in. So it means that there are more opportunities for us in terms of some of these cost takeout deals, which also tend to become more longer-term annuity opportunities.
But many companies we spoke to, Persistent, HCL Tech, they all indicated that furloughs are likely to extend into Q4. The impact is not going to be as much as what we saw in Q3, but it's not going to be negligible as well.
That's exactly what I said, that some of the furloughs may extend, but we don't anticipate. I mean, there are multiple factors. You can't just focus on only furlough, but that's why I said that including all the factors, we have done our maths. We feel that 200 to 200 basis points improvement in margin from where we ended in Q3 is definitely a possibility, and we are very confident about that.
Can you talk about this 4 to 5 year plan that you've outlined, of $1 billion revenue synergies and margin improvement of 200 to 300 basis points? What is driving this guidance? What have you baked into? What are the assumptions that you've made?
Well, we are right now going through the strategy exercise. We have, rolling out the plans in terms of what we see the organization in the next 3, 4, 5 years. And we probably you have to wait a little longer before we share all those details in the coming quarters. But one thing is very clear, that the entire parlance of this merger was to generate more synergies in the marketplace. And given the capabilities that we have as an integrated organization, we are very confident that our upsell and cross-sell opportunities are going to help us in terms of creating more synergies. And that's what we talk about. That's what we feel as we are very confident over the next 4 to 5 years, we should be able to create $1 billion in revenues in terms of synergy. And we also have been saying that the synergies in terms of revenues will be front-ended, because that's what is going to be our focus at the initial phase when the organization comes together, which is now. And as we go along, given the larger scale, there'll be a lot of opportunities of synergies in terms of efficiency as well. But that will be slightly back-ended. So we are going to focus on that over the next, next years. And again, we are very confident that 200 basis points of EBIT improvement is possible over the next 4 to 5 years.
The EBIT margin improvement and synergies is 200 or 200 to 300?
Around 200 basis points.
200 basis points.
Yeah.
Okay. Got that point. Since this is the first quarter, we don't have much by way of a track record, but 1.25 in terms of $1.25 billion in terms of deal wins. Is that the quarterly run rate we should expect from the company now?
Well, I think the deal wins should never be looked at a particular quarter. You should actually look at it over a particular year. And as you rightly said, this is the time when we are creating the baseline. So we have to see how it goes. But definitely, given the pipeline that we have, we expect to, we are also working on quite a few large deals as we speak in various industries. And we should be able to report the deal wins as well as the order book as we go along. But I would request you to look at it over a 1 year period to just form some benchmarks.
Do you think this could be the new base for deal wins, $1.25 billion?
I mean, we are very confident with this base, what we have done so far. It gives us a lot of confidence in terms of growth in the business in the coming quarters.
All right, that is the management of LTIMindtree. They're saying that deals in the pipeline suggest that growth will actually be better in the coming quarter as compared to Q3 as well. But with that, we're going to get into a short break now. But a quick programming note as we do that. And here's an update for our viewers. CNBC-TV18 has compiled a list of top 20 stocks that you should watch for this year. It is a carefully curated list of companies that warrants a closer look in 2023 based on factors like growth prospects, new launches, management changes, reforms, and lots more. As a disclaimer, this definitely is not a recommendation list, but a list of companies which have meaningful triggers lined up this year. So tune in to CNBC-TV18 tomorrow at 10 a.m. when we will give you a sneak peek into the names and reveal the list.